As per the data released by the Indian government, the real GDP in Q1 of financial year 21 shrank by 23.9%. With this, India became the worst performing economy among G20 nations in Q1. United Kingdom followed closely with 20.4% contraction in GDP. India is a developing economy and is now facing reversal in capital flows, currency pressure, and limited fiscal space to provide relief amid a health crisis. The worst downfall in past few decades can be attributed to nil economic activity and cyclical global slowdown combined. A supply side blow would only worsen the economic outlook. There were supply side disruption as COVID-19 wave hit China and companies dependent on imports were affected. The coronavirus pandemic brought uncertainty to all economies worldwide. With it came the imposition of stringent lockdown nationwide. The aftermath of the lockdown is now visible in GDP figures. Economic activities were completely shut down. Curbing the spread of virus was top priority. The magnitude and speed of collapse in activities has been tremendous and far greater than any other economic crisis. Major portion of the shutdown was covered in April and the gradual revival only began by the end of May 20. The strict lockdown measures rendered many jobless and forced migrants to move back to their hometown. Industrial output was very low as existing inventory had to be out first, hence, no net addition to output. In anticipation of reduced demand, factory closures obstructed global supplies. Policymakers gave the economy a little cushion through timely fiscal, monetary, and financial aid via credit guarantees, liquidity facilities, loan moratorium, and tax relief. The support was given to contain the impact of subdued investment and job losses that rose exponentially. However, as uncertainty prevails till there is a definite end to the novel coronavirus, policies must shift to supporting demand, incentivizing hiring, and helping sectors grow to aid recovery. Demand is contracting heavily, and the capacity to neutralize this has been reduced severely because of tax collection. However, COVID-19 alone can't be blamed for the sharp contraction. Earlier also, the fall was visible in all sectors. The economy was already reeling under a demand depression, rising unemployment, and low industrial output. The worsening financial situation and further breakdowns of global supply chains have played a significant role in fall in GDP. The shocks could have been absorbed, but the unfavorable conditions hit the Indian economy harder than the rest. The cost of the crisis has been reflected in the steep fall in GDP. The drivers to an economy are the private consumption, government expenditure, investment by the private enterprises, and net exports in the financial year. As stated previously, consumer demand has been falling, mainly due to the shock from demonetization and a hasty rollout of GST. Further, consumption deteriorated as businesses closed and households hold off on major purchases worrying over finances. Boosting demand is critical for economic revival. Government consumption or expenditure rose to 18.1% from 11.8% because of the stimulus package introduced to provide aid. Net export demand grew, but only because imports fell and not an increase in exports. The only silver lining was the increase in agriculture sector by 3.4%. Output level in the sector rose due to good harvest and relaxations provided during the lockdown. A V-shaped recovery is expected in economic activities as production and consumption, both spur and revenue collection performance of core industries rise. Government spending and reforms is expected to help the growth rate towards a positive outlook. while RBI's key role is to keep long-term interest rates under check and avoid higher inflation which may arise due to liquidity infusion.